Hello, everyone. If you're an immigrant to Canada who has recently launched a business through the Startup Visa program, you're likely asking yourself, now what? How do I maintain and grow my business? How can I structure my company to maximize benefits? And how can I optimize my taxes? Well, you're in luck. Today, we have a special guest joining us to share his expertise on these very topics. Karl Nour, Senior Wealth Advisor from Nour Private Wealth, and he is here to share his insights with you. So whether you're just starting out or looking to take your business to the next level, this video is for you. Let's get started. Hi, Karl. How are you doing today?
Hi, Anna. I'm great. Thank you for having me today.
Thank you very much for making the time and joining us. So let's dive in and let's start with the basics. So when I come to Canada, I'm a startup owner. How should I structure my business?
Excellent question. So there's no one straight answer. Truly, what it comes down to is the type of business you're running. Most people, if they're the only employers, they're the only employees of their own business, they rarely incorporate upfront. They start as sole proprietor and then they can register because there are costs associated with that. There's registration fee, there's annual reporting of taxes, both for personal and for the corporation. But obviously, the ideal goal in this case, if you are running a business that allows you to incorporate and benefit and you're earning sizable income to justify the incorporation, the tax law in Canada favors incorporation, whether on an annual basis, on a succession plan basis, on your retirement, on your exit. The ideal goal is to incorporate and grow your business. Now, upfront, perhaps you may have an idea that you're setting up. You may delay it a year or two until you fine-tune your structure before you incorporate. And incorporation takes about 15 minutes online on the Canadian government website. It's a very simple way to get your registration number, but obviously there's a bit more to it in terms of taxes, which becomes a bit more complex. I wouldn't recommend incorporation before you have a right footing in terms of your business direction. That could be as simple as few months of setting up.
And do business owners need a trust then?
The word trust is a bit fluid. I know more recently everyone talks about trust, but if you speak with an equipped lawyer, you'll be familiar with the knowledge that there are many trusts. There are living trusts, estate trusts, there are some things called Henson trusts, family trusts, so on and so forth. But when it comes to business owners, let's focus on that. The word trust is used to discuss something called a family trust. A family trust I tend to use for my extremely wealthy clients. However, it does not take a priority. It is a succession move to be used later stages once you're fully set up. Precedents take an operating company, which is you're running your business. If you are expanding your business, you have your employees, you're growing, whether you decide to sell young or work through your expansion of business 30, 40 years and sell or transfer it to a loved one, the idea is that you would reach a point, knock on wood for everyone listening, that you become a successful entrepreneur and a business owner. Any surplus money, you send it to the holding company, which you will eventually set up. Now, whether a trust is set up to own the holding company, whether a trust is on a personal side, that is not an urgency. This is a way to, it's a fantastic structure, but in Canada it has limitation. Every 21 years, it has to be wrapped and pays taxes, unlike the United States, for example, it's 100 years, or different countries. So I do not advise setting it up front because there's significant cost. It could be 5,000 to 25,000, and you do not need it. By the time you set up the company and you actually use it, those 21 years may be done. So don't go into the cost or be so attracted to the titles of owning a trust or having a trust set up. There will be time and space to set it up down the line. In the beginning, cash flow is key. So don't overspend of things that do not take priority, and the trust from the get-go is not a priority at all.
Right, I see it. Thank you very much. What are the benefits of a holding company?
Great question. So a holding company allows business owners to separate profits in the business, and as opposed to keeping the surplus profits, should they, deem that, hey, it's their portion, to move it to a holding company. That allows them to invest in other vehicles, whether, individual securities like stocks and bonds and funds and ETFs, or whether they're looking to buy real estate for residential use or even business use. The goal of why you may want to set it up in a holding company, because if, again, knock on wood, you reach a point where you decide to exit your business, you do not want the surplus money that you're building for your retirement to be part of that operation. That allows you to separate things and create an arm's length, reducing the complexity down the line to separate assets. In addition, it reduces the liability, as any assets you leave in the holding company for personal, commercial, or any other investment reasons are separated from the operating company. So it creates this layer that is highly, highly, highly recommended for every successful business owner. And that's actually step one, way before the family trust that we referred to earlier. But again, do I recommend it upfront, day one, $1, when you're setting up the business? No. My advice to every single listener that is coming to Canada and looking for operation: protect your cash flow. There are a lot of fantastic business ideas, very profitable ideas. Cash flow is the biggest, I'll call it, kryptonite to allowing a successful idea and a business owner to survive enough to see the fruits of their labor translate to a successful company. So a holding company, my suggestion will be, when you have significant surplus enough to justify that you're comfortable enough with the operation cash flow of the business, that's when you go ahead and set it up. It doesn't add any other cost. There's no need to change your operating structure or any of the sort. It's something that comes down perhaps 3 years from now from the setup, or 5 years. You have the luxury of being patient there. So that's what the hold goes for.
That sounds great. Thank you. While we're on cash flow, I would like you to, if you could elaborate on maybe employee benefit structures like RCA, or just in general employee benefits.
Fantastic question. So part of expanding a business, you come to a point where you see what's most important for you to keep a successful business is retaining key clients that have been beyond added value to the success of your business. So when it comes to client retention, studies have shown that while you may cut on certain costs if you hire new employees, you think upfront based on the salary. Actually, to generalize, most of the time, it's less costly for the business to retain key employees that have been successful in that transition and reliant, because you don't have to train them. You can continue. You don't have to hire new people. There's a good connection there and like-minded individuals to grow a business. When it comes to that, there are certain benefits you could provide your employees as well as yourself as a business owners, or if you're working with a partner or a family member, your spouse, your son, your daughter. If it's a family business and you have different employees, there are many benefits. Some of these benefits are group benefits, for example, which is basically health insurance. Where the group benefits come into play is that you would be able to get certain things like chiropractor, massages, medication at a reduced cost, as the insurance pays 80% of those additional medication costs. So that helps with people that perhaps are older, that they need more medication, and the cost of that insurance is averaged down by the younger employees that don't quite need it as much. So these are certain benefits. In addition, it provides disability benefits. God forbid something happens on the business, they're able to be covered. The business doesn't incur that cost themselves. It's covered by that insurance. So those are group benefits. Now, there are other things. There's group RSP, or defined contribution pension, which is, simply put, it's a way for employees and employers to contribute to their employees' retirement savings. That is an advantage for the employees to reduce their taxes on an annual basis and for saving for retirement. It's a tax deduction for a business. And instead of it being an increase, purely an increase of salary, that is gross income and taxable, the employees and employers in this case get a tax write-off and forced savings that essentially doubles up for future benefits for decades to come and on an annual basis. Now, to add to that, just because it's a very broad question, if you get to a bit more advanced level, even if you don't have significant employees or you decide you don't want to provide those benefits as what your employees are receiving, for very high income earners above the age 40, where really their business is very successful, we have certain structures called IPPs. They're basically a replacement for a pension or your RSP. It provides the high income earners, the business owners, with significantly more retirement savings capacity. Why is this important? It reduces their personal income and their company's taxable liabilities. In addition, to reduces payroll tax, which is something you'd notice that you'd have to pay once you're doing your payroll and so on. In addition to those benefits, should you be fortunate enough to grow your business significantly, upon the sale of that business, there are tax implications. So how do we reduce that tax burden upon that exit? First, luckily for Canadians, the government has something called the lifetime capital gain exemption, which doesn't require an account, doesn't require any additional cost. It allows business owners, based on today's 2024's estimate, about $1 million in tax write-off upon the sale of their business. Now, should that be sufficient? You don't need to do anything else. Should you be fortunate enough where you have grown your business beyond that and you have more tax liabilities, there are certain structures that could be set up, such as the individual pension plan, retirement compensation agreement, that provide more of a tax deduction upon the exit. That allows you to reduce that tax impact, protect more of the hard-earned money and capital that you've worked very hard for. This is complementary to, which is important to note, Anna, on the exit is talking about insurance. I'm transitioning to the insurance when I've talked about the pension because it's complementary for two main reasons. One, protecting your business as it's operational. That's key importance, and I'll cover that. The second is viable upon the exit, and most importantly from that angle is for the eventuality where, hopefully not before your 90s or 100. When that happens, your goal is to keep as much money to your loved ones or, even charities without it being dwindled down. So at least having a control of where you want your legacy to go.
Right.
That being said, where does insurance kick in? So let's uncover some of those because they do play an impact based on trust, setting up a trust, if a holding companies, IPPs, RCA, insurance. If you're setting up a business, whether you're a sole business owner or you're working with a partner, 50-50 or 60-40 or 70-30. One of the things that people do not plan for is that for the unfortunate circumstance that one of the partners unfortunately passes away suddenly. Now, luckily, because they're partners, the business can continue to operate. But here's a question that we should be asking ourselves. How do I pay out my partner's family that deserves to be compensated for their portion? What if I do not have, I have on paper the assets to pay them out, but I do not have the liquidity, the cash to pay it? So what are my options? One option being, hey, I can perhaps go to a lender that could understand maybe and give me loans. But what if you've already taken enough loans on your business because you're in a position where you're expanding? It's all great numbers. However, you've reached the capacity to take on loans and then you're stuck. So what do? You go look for another partner. You're a bit of a pickle. You've cornered yourself. Luckily for you and for your business and your partner, there is something called a buy-sell agreement. It's a term policy that's paid by the company that pays out the surviving partner. It's a legal term, but the insurance portion of it covers the proceeds of the exit, should that happen, and pays directly to the family of the person or individual that passed away. This is a way to protect liquidity for those odd circumstances that no one wishes upon themselves or their partners or their family. Other benefits. So that's if it's operational. Obviously, there's more add-on, but that's a key important topic for a running business. In terms of estate, you are successful. You're a business owner. You set up your holding company. You transferred extra funds. Even you went ahead and you're beyond successful where you needed, a family trust to own the shares of the whole. Eventually, though, upon death, husband, wife, wife, and partners living together. Eventually you pass away, and even though you've done every single possible structure, holdco, trust, so on and so forth, when that happens, there's a tax liability that cannot be avoided. What are the smart things to do? Here's the question we need to raise. How can I keep the most out of it? I've done my structures when I sold. I've done my RCAs, IPP, lifetime capital gain. But at some stage in time, whether I sell my business at 40 years old or 9 years old, it's irrelevant. Eventually, we have to pay our dues back to our society, great society we live in. There's a structure in terms of buying an insurance policy. The goal of that is that it uses corporate tax dollars to grow within your business that actually grows with your business. You could pay it over 10 years, 20 years, or for life through corporate dollars. And that allows, upon the death of whoever's covered, whether you and your partner or just an individual owner, to pay out taxable dollars, tax-free out, which in turn allows for what otherwise would have been taxable proceeds to flow money out tax-free. So these are very important things. Now, when do I buy such a structure? Ideally, in a perfect world, you buy them early on because as many insurance, most people are aware, it comes based on how much we're buying, your age, your health, so on and so forth. And we tend to be healthier when we're younger, most of us, and thus the cost of buying them are lower. Now, we could start with a lower amount, add some later, but these are important things to plan ahead of schedule as well. Now, how much do we buy? There's no right number. It depends on your business, the success, how much do you need? Do not over purchase things. What's most important is to identify that answer. What do I need and when? Is working with an equipped holistic advisors that are able to work with the accountants, the lawyers, your actuaries to help you organize things, prioritize things, help you manage your cash flow, leave you on the right direction so that you can focus on the most important thing, which is your true success and money maker, your own business.
Exactly. Karl, I can't thank you enough. You gave so many valuable insights to our audience today, and I hope it will help them in their aspirations to move to Canada.
I'm happy to help.
That's it for today, folks. Stay tuned for more expert tips on navigating the world of business in Canada.